venture lending and leasing. So we know about vendor financing. So we might have trade terms like accounts payable or trade notes and 210 net 30. But venture is quite different. Venture is where they provide you higher risk money, and whether that's a loan or a lease, and they do so with either higher interest rates or some warrants that give them an equity sweetener, so that if you're successful, or hopefully when you're successful, they not only get a good interest rate, but they also get an ownership in your company. And these could occur through a bank's non-banking subsidiary. A good example of this is Silicon Valley Bank. Silicon Valley Bank makes commercial loans. They're a bank, but they also have an equity investment arm that could do stock transactions such as preferred stock, or they can accept warrants in the bank. So there are many variations on how Silicon Valley Bank can provide money to ventures, but also have not only fixed return, but also an equity sweetener for their efforts. An example of a venture lease is one that I actually worked on, so I know this very well. It's a sale-leaseback transaction. Now, sales-leaseback transactions are not just for ventures, they're for any business. So this is a generic type of transaction. When you add the word venture in front of it, it just means that there's a little bit more going on. But let's start with the basic idea of a sale-leaseback, because you may find this handy. So step one is you buy things. You're a company. In this case, you have 3 vendors. You pay cash and you get assets. Now the company owns assets. Nothing unusual there. However, now the company needs money, so they find a leasing company and they sell the assets to the company without physically transferring anything. They'll sell their factory equipment, or they'll sell a building, something like that, to a leasing company. The leasing company now has the ownership of your asset and they give you cash for it. So that's the sale part. The leaseback is simultaneous. The leasing company and you sign a lease because they don't want your factory equipment and you need your factory equipment. So right after you sell it, or simultaneous with you selling it, you lease it right back from the leasing company for a certain amount of dollars per month. So what have you just done? You got an upfront large check today for your assets that you will lease back and have continuing use of these assets for, say, 5 years. It's just that from now on, every month you pay the leasing company some amount of money for using that equipment. So this is a technique to get cash up front and pay it back over time. So it's kind of backwards lending, right? So you could have, if you had thought about this, you could have borrowed money and earmarked those funds to buy factory equipment, and then spent the money and pay back a loan to the bank. That's kind of a traditional way to do it. But in this case, the sequence wasn't like that. You had purchased assets, perhaps thinking you had cash, all the cash you needed, or perhaps there was no other way for you to get the assets but to pay cash. And then subsequently you make a payment. So this is a specific example. Now, when you put the word venture in front of it, the right side is red because it's a venture leasing company, not the same as a more traditional sale-leaseback or a leasing company. This is a venture leasing company, which means they want to sell it to you, but what they get in return is not only a lease, but they also get warrants. They're going to get warrants in your company. So when you're successful, in addition to getting a good interest rate, they're going to own a part of your. An example that I mentioned to you is that Alibris had one of these transactions. So we got venture funding. We got hundreds of thousands to start off with, and then millions of dollars over time. Then we used that cash to buy equipment, computer equipment, hardware, and even some customization of software. And I had on my balance sheet all those monies spent. So I sold those assets, including the software and some of this customization, to a leasing company, got a large block of cash that I could use for operations. And then we paid monthly fees to the venture leasing company, and they own warrants in Alibris, so that when we made money and our valuation had some liquidity event, they could cash in those warrants and make money. So this is, again, another illustration of the use of warrants, right? It's a sweetener to induce somebody to give you a large amount of money up front and for you to pay them over time. In this case, not a loan, it's a lease. So this is a very powerful technique, and companies have been in this business again for many years, but they're not crazy people. They lease assets that have value. They lease it at rates of return that's high to them, and they have this little equity kicker where if one out of every so many of their clients hit it big, they make money from the warrants. So this is a way for them to be on the risky fringe again of leasing, but also have a way to get that money if the ventures are successful. Next is learning objective 4, which is receivables. Now, how can you do lending or factoring of receivables? And the scenario is clear. You have a nice product, you sell it to customers, they say we'll pay you in 30 days, but you're growing so quickly that that alone is burning your cash. You need that money to grow your asset base. So what do? One is you could do a factoring where you have a stack of paper, which are invoices that you've issued to your customers, and you take that stack of paper and you sell it to a bank. So the bank now owns those receivables. The problem is you have to tell your customers, hey, you bought that $100,000 thing from me, software from me. Don't pay me, pay XYZ party. And the customers say, hey, why are we doing this? Are you in financial trouble? Why are you having me pay somebody other than you? And the answer is obvious, because they bought that receivable. So factoring is seen as a little bit desperate, and it isn't always desperate, of course, but it has a little bit of that stigma to it. So before you factor, you want to be very careful, and you better be ready to explain to your customer why it's not indicative of you being in trouble. Next is receivables lending. So this is also a thing you could do. You have a lot of loans, big stack of loans, but rather than selling the loans, you could pledge those loans as security for a loan from the bank. So in this case, the customers do not know that you've gotten any money based on their good credit, but you have an interest rate that you have to pay the bank, but you're happy to do this. You're happy to get the money from the bank to finance these receivables, and you're happy to pay the interest to the bank. And you did so without having to tell your customers that you're a little light on cash. So there are some variations on how DPOs are affected. So one is through an auction method of an IPO. And we're going to do more of this when we cover IPOs. But for now, just know that it's possible to have an auction method. Just remember that. And when we get to it, I'll explain and give an example. Next is what has been kind of brewing for the last 10 or so years, crowdfunding. And before, it was very casual. Crowdfunding was not really about money. It was you saying, when you make that particular product, I'll get it. So I'll give you some money, paying you in advance for that gizmo that you're now developing. Well, now instead of having a product or some premium associated with crowdfunding, you can actually sell shares, sell stock. So I give you $100 and I don't want the product. I want to own a part of your company. And so the Jobs Act enabled that to happen with very limited dollar amounts. Roughly $1 million can be raised using this method. So it's not small, but it's not certainly like a big IPO. So crowdfunding has now been legitimized, and through a set of procedures and filings, you can crowdfund and receive money in exchange for stock.